Hi, Nick Neal with New American Funding and Nick on Rates for Friday, May 16th. Hope you are ready for a nice weekend. We've got Tucker with us today. We usually have Sebastian telling us what's happening with the market, but Tucker wanted to get involved. Here's our long-haired Chihuahua. Weighs about 5 pounds and he's 14, but he still looks like a puppy. And he howls when something is either irritating or bothering him. Right now, when he's happy, it's kind of like an aloha, but it goes both ways. But he's howling right now because we had a good end to the week and actually good week. And it's like, come on, what's going on? And then finally today had some good action in the market. But he's also howling because Powell needs to start dropping interest rates. I had an online Facebook thing with this and people were going back and forth. Well, he's really smart. He knows what he's doing. But the Fed's had a pattern of holding on too long to reduce rates and actually causing a little bit of trouble, bringing us into recessions. When you do things like they do with monetary policy to affect the market, it's not an initial reaction. You're going to have monetary policy either shrinking or growing. You know, if you're lowering interest rates and you're trying to improve the economy and get things going, it takes a while for people to buy stuff, to buy equipment, to grow companies, to hire new people. And it's a reactionary effect. It doesn't happen right away. Same things happen with shrinking. When you raise the cost of debt, people don't need to borrow right away, but then they start borrowing, it's more expensive. So they start backing off, they start slowing their spending on the consumer side, and they stop developing new business and building their business on the producer side, the retail side, and the commercial side. So that's what's happening, and those things are happening in the market. And once they happen, they're like a train. You build momentum in that direction, it's going to continue. So if you wait too long with what you're doing to have an effect on the market to where you can see it, literally companies dropping around you to see that the economy is slowing and things are, inflation is no longer going to be a factor, you've gone too far and you're going to push us past the point that we need to be into a recession. They talked about, a slow, stable just a stable roll into a comfortable economy and not having a big crash or not having to, extreme things. I don't remember the term that they used for it, but it was kind of something that we'd like to see, just kind of a smooth landing. That's what it was, instead of, crashing the economy to slow inflation. And we can do that if we'll start lowering rates, because we're at the point now where we had this week, and again, it's technical factors that has been driving us. We had a really good downward trend like we talked about, and then we had that turn on us. And it started up again, which we know that we're going to see because we get the up and downward trend. As long as we maintain this downward trend line, we're still good with rates. But once things go up past this trend line, then we're breaking out of it and we actually started to create an upward trend. We talked about that last week. Right now, during the week, we had things coming out, and all of this is technical factors. We've got they're called Fibonacci lines. These lines of resistance are built into the data with equations that track data over long periods of time, and they're amazingly accurate. It's all technical to do with trading and other factors, technical factors that cause the market to go one direction or another, or to maintain one direction, or to stop or pause like they do when they hit these lines. And we've gotten to a point now where we were getting down into the bottom quarter, almost to the bottom quarter of this trading range that we've been. We had a really good high up here. This is low interest rates, high interest rates down here. And we've gotten down, we got down to where we literally coming into the bottom quarter and didn't quite get there. And then things started to turn back. And now we want to come back and get back into that downward trend with treasuries again. These are going down is good. The red is good. So what happened this week in the markets? Core retail sales came out Thursday at a 0.1, expected 0.3, so that was good. And that had a good reaction yesterday for us. Prior to that, there really was news that was happening that was good, but it wasn't having a reaction. We were still getting the negative move, the upward trend in treasuries. We had CPI numbers come out earlier in the week at a 0.2, consumer price at a 0.2, which is good. Inflationary is anything higher than 3 and going up. And the Fed wants to see numbers in the 2, and we're literally in 2.3 right now for year over year with CPI. And that's one of the main numbers that they watch for inflation. Expecting a 2.4, they got 2.3. And the monthly CPI was a 0.2, expecting a 0.3. Last month was a 0.1, so that was a little higher than last month, but it's still really low and it's still in the range that they want to see. The big number, a month ago, we had a CPI number that was actually negative. When we talked about having a recession, you have 2 of those in a row, 2 quarters of negative CPI or GDP. You're going to have, negative recessionary factors. So we're getting some low inflation numbers that are actually the reverse, and we're, prices are actually reducing. It's not that they're increasing anymore. And we had one of those with PPI yesterday. PPI came in at negative 0.4. So that's a negative number where producer prices are actually going down. They were expecting a 0.3 and we got a negative 0.4. So that was really good. And so on treasuries, it had a nice effect, and this nice big red line coming down again. So we're finally getting technical factors and our numbers to do good things, and we've got the line coming down. That was just today. We got the nice turn on the, and CPI was just today. That's right. We got the nice, or PPI was just today. I'm getting my numbers mixed up here, but anyway, PPI came in good, and that's what caused us to get in and come back down under this trend line. So the downward trend line, again, we're back in line with that, and if we can stay in this range, we had come all the way up to the Fibonacci technical factor line right here and hit it and bounce back down. So a lot of times you'll just go up and down between the lines until economic news happens that'll break you out of it. But we're down under the trend line again. We're coming down to another area of resistance. So if we can get down here, have some good stuff happening next week to get us through this line, we can continue back on this downward trend. And to do that, we need to get back under this area of resistance on the Fibonacci line, which is 50%, which is a pretty tight one. That's a hard one to break through. As you can see, there's a lot of activity that happens right around that middle line. If we can get back below that, we're good. And then on treasuries, that's what got me a little bit, because yesterday with the PPI numbers after good CPI numbers, we really had a nice bump up in treasuries. And these are the ones that actually totally affect the mortgage market. So this is where mortgage interest rates come from. You can see this nice big green up. Green is good on this one. It's the reverse of treasuries, because as the price goes up, the yield goes down. So we want people to buy more of these. And we're coming back up into the middle of the trading range again. Again, we broke through down into the bottom of this four technical lines. We broke through into the bottom one, but we've come back up above it. And if we can continue to do that and continue to follow, I don't have a good upward trend line here. We did start to kind of, or downward trend. That's what we want to see. I don't have the line drawn here, but you can really see that if we can continue on that path that we're getting back into our nice downward trend line, that's what we want to accomplish. So good things for treasuries, good things for bonds, good numbers with inflation, good numbers with employment. We had flat employment numbers this week, 229 jobless claims, expected 229,000. So everything's coming in good. Fed, you got to drop rates. Come on, Powell. And if you don't think so, then, and listen to them, we're going to end up with a recession. So that's what we don't want to see. We don't need to see that. We can have inflation come out and get a slow land or a soft landing without having inflation. Call me, text me, fax me if you need help with the mortgage. So I went a little bit long today, but it was kind of a turning point with the news, and I just want you to see how we're in a point now where hopefully we're gonna continue on with our downward trend. Mortgage applications are pretty flat right now, but they're going up and we're getting more business. People are starting to buy houses because it's springtime. So call me if you'd like to look at loan options. If you're a realtor and want to talk marketing, I've got experience with over 300 agents in the past, with teams as big as 29 or 30 agents working on different types of marketing activity in Bellevue, Kirkland, Seattle, and the Peninsula. So be happy to talk to you about marketing ideas. 360-286-5037. Have a great weekend.